Good morning. So I'm looking forward to, let's see, make sure my thing is working here. Now we're going to need slides, otherwise I'm really going to ramble there. Here we are, all right. All right, here we are. So pleasure to be here today, and I really love this conference and this venue. I think you've got a great lineup over the next 2.5 days, and I think there'll be a lot of really excellent discussion. I'm going to be provocative here and get it started off on the right foot, because I know that this is a feisty crowd. So I'll talk for about 30 minutes on this subject, and then we'll, so I'm drifting forward, sorry. Giving the whole talk in seconds here. I don't know why this is doing this. So I'll talk for about 30 minutes, and then we'll have plenty of time for Q&A on this. But I do want to try to get this point across. This is not going to be the simplest matter, because I'm going to refer to frontline research in macroeconomics. So we'll see if we can keep the slides from going back and forth on us here. Okay, so it's called Some Unpleasant Implications for Unemployment Targeting. And the bottom line will be really don't push unemployment targeting onto the monetary policymaker. You've got to look to other types of policies, labor market policies, to get the right policy there. So we'll see if we can get to that point. This thing likes to creep forward here. So we'll start off with policy advice. This is just the standard policy advice as it exists in the literature. So the standard policy advice from the new Keynesian macro literature has been sort of wildly influential. Can we fix this so we're not flipping around? Is there something different I'm supposed to be doing? This is going to be very hard to follow, I think, if we keep flipping around here. Maybe we should get this fixed first. So we'll pause. I can tell some jokes.
Tell some anecdotes about the FOMC.
I can't reveal that information. Stay. Okay, that looks a little better. All right, so we're going to start with policy advice. So there is a new Keynesian macroeconomics literature. It's headed up by Michael Woodford at Columbia University here in town, and his co-authors. Wonderful work, very influential. And it's really informing central banking around the world. And the key things, if you don't know too much about it, the key thing is that you assume sticky prices at the beginning. And that's kind of the key problem in the economy. So what's sticky prices? It just means that the prices that you see out there are not really the ones that reflect supply and demand at every instance. So supply and demand conditions are changing often, but the prices aren't changing as often as the supply and demand conditions. So that's a controversial assumption, and you can go in the literature and argue about that, but I'm not going to argue about that today. We're just going to take that as given, that the sticky price problem is the key problem, because that's what the literature assumes. And then there's a central bank that controls a short-term nominal interest rate, which sounds like the Federal Reserve. And you can mitigate this sticky price problem, and you can get better outcomes than you would get if you just stayed out. So this is an argument for intervention of the type that central banks actually do. We move short-term nominal interest rates around to try to mitigate the detrimental effects of the sticky prices. All right? And what about the zero bound? That's taken care of as well, because when you're at the zero bound on the policy rate, you can also promise to stay at the zero bound even longer than you otherwise would, and this also helps to create a boom today and helps to mitigate the sticky price problem. So in some sense, even the zero bound is not a problem in this literature. So the Fed has experimented with this forward guidance policy advice that has come out of this literature, so it has been very influential. And recently the Fed, the FOMC decided to link that to economic conditions. I think that was an improvement in the way we do our forward guidance. But that's not really here nor there for this talk. Anyway, you can handle the zero bound in this, even inside this literature. So this has all been very influential. And the essence of the NK, so NK does not stand for Narayana Kocha Lakota, who will be here later. It stands for New Keynesian. So the New Keynesian policy advice is, if you just took it at a layperson's level, is just say, let's just keep inflation close to target, and you'll basically get, that'll be the good policy. And indeed, the FOMC adopted an inflation target in January of 2012, but we were perceived to have an implicit target long before that, but I thought it was a good move to actually adopt an official inflation target. We reiterated that in January of 2013. Now, technically, the policy advice is not the inflation rate, but the price level path. It's really price level targeting, which is optimal in the New Keynesian framework. And you might ask, has the Fed been a long ways off on its price level path? And the answer, has the Fed maintained such a price level path? The answer to that is yes, and I've talked about that in a previous talk, a singular achievement of recent monetary policy. So I think this can, comes through in this picture here. This is personal consumption expenditures price index since 1995, and 1995 is indexed to 100. And then the green line is if you just had a price level path dictated by a 2% inflation target, and the red line is the actual path of PCE inflation during this whole period. So we're basically right on the path. And let me tell you, this does not always happen. So if you look at Japan over this period, this certainly did not happen for Japan. Or if you look at the US and the Great Depression, it did not happen. So whatever's going on, we did maintain the price level path, which is sort of the optimal policy coming out of the New Keynesian literature. So actual policy since '95 seems to have mimicked the policy advice emanating from the New Keynesian literature, and that's despite all that happened during that 18-year period. I mean, you got the tech bubble and a recession, you got the financial crisis and everything that happened. Nevertheless, you're basically right on the price level path, which is right where the literature says you should be. However, as you guys know, and I know very well, gosh, there's no unemployment in this model. No unemployment, can't be serious, right? And today's level of unemployment looks quite bad in the US. So what's going on? What's going on? Should we trust this literature or not? So let's talk about unemployment. Unemployment is certainly high by historical standards in the US. It has declined from a post-recession peak at a rate of about 0.7% per year. That occurred during several years of relatively weak economic growth of around 2% per year. That's very similar to the US experience in the 90s and again in the 2000s in the aftermath of the two previous recessions. If we stick with that kind of pace, we'll be in the low sevens by the end of this year. So here's the picture. Here's unemployment since January of 1990 in the US. The shaded regions show the periods of decline in unemployment after the peak level of unemployment, and the current period of decline is not too different. Pace of decline is not too different from the pace of decline in after the 1991 recession or after the 2001 recession. So whatever's going on, these three episodes are not very different on that dimension. So the idea would be, should the Fed, the key question in my talk here is, should the Fed adopt a monetary policy that puts more weight on unemployment? Well, you look at the literature, the leading literature on this, the answer is no. And that's a very surprising answer, and that's what I'm going to talk about here today. So I'm going to mostly say, how can we understand this finding that you should not put more weight on unemployment even when unemployment's high? So you're going to have to get used to these guys. This is Federico Ravenna and Carl Walsh, and I'm going to mostly use their research on this topic. They're leaders in this field. Federico Ravenna is at HEC Montreal. Carl Walsh is UC Santa Cruz. They've got a state-of-the-art paper on trying to investigate this question. It's a published paper in the American Economic Journal Macroeconomics. So what are they trying to do? They want a fully optimal monetary policy in a model that has the sticky price problem from the previous literature and has what we're going to call search theoretic unemployment. And they've also sharpened their conclusions in more recent work. I'm going to talk about that. So what do they want to do in their research? They're asking very much the question that's in your head right now. You're saying, well, why, if we included unemployment in the model, then surely you'd put some weight on unemployment when you're trying to do monetary policy. So what you want to understand is whether this maintained price stability advice survives in a new Keynesian framework with explicitly modeled unemployment. And if you're not used to this, you have to understand that unemployment is actually a difficult topic for macroeconomics. It's a difficult topic for macroeconomics because what you have to do, you can't just say workers and firms all meet in one big well-raising market and everybody's happy. No. That doesn't work if you want to talk about unemployment. You've got to go to search-based ideas. The search-based idea is we're all in matches with our employers. Those matches dissolve. You don't get a job instantly. It's hard to find a job. You've got to go search for a job. So that's the search theoretic part. So the match breaks up. You gotta go look for a job. And this line of research, search theoretic unemployment, led to a Nobel Prize for Peter Diamond, Dale Mortensen, and Chris Pissarides in recent years. So that what you want to do is bring that idea into the new Keynesian sticky price framework and then see what the optimal policy is in that world. And the last thing, the last part of the focus of the research is we don't want outsiders to the model coming in and dictating what they want to do. We want to ask the people that live inside the model, what would you have us do? Given that you face unemployment problems and given that you face sticky prices, what would you have the monetary policymaker do? So you want to do it from the perspective of those guys, not somebody else that might have something else in mind. What would be the best monetary policy from the point of view of a household facing both sticky prices and unemployment? So they've got both these things in the model, and so it means that when you're living in this model, you're facing prices that don't move one for one with supply and demand conditions, and if you lose your job, it's going to be hard to find another job because of the search friction. So it's hard to find a job. And we know that if this economy is all done very carefully to match up with the previous literature, this is a strength of Ravenna and Walsh. So we know that if you just had the sticky price problem in the economy, you would take this price stability would be the general advice that you would get out of that framework. So will this advice change when these labor search frictions are included in the model? Now what they found was, so what you would think is, okay, now we have the sticky price problem, we got the labor search frictions in the model, and surely the policymaker is going to somehow trade off these two things, and you want to try to partly mitigate the sticky price problem and partly mitigate the labor search problem. That would surely be the intuition that you would have. But that isn't what happened. The optimal policy is actually still very close to price stability, even with the unemployment explicitly in the model. So the policymaker in the model still does best by following the maxim, just keep inflation pretty close to target, and that'll be close to the optimal policy that you can get. If you try to put more weight on unemployment inside the model, the way people might have in mind, you can get very negative outcomes for this economy. And they talk a lot about that. If you take some say, monetary policy rules from somewhere else and you impose them on this model, you're going to do very badly. So what I want to do is take the policy advice coming from Ravenna and Walsh seriously, at least as a benchmark for how we should think about dealing with unemployment through monetary policy. Now, be careful here now. There are policies that can fix the unemployment inefficiencies that are in this world. They just aren't monetary policy. There are other policies. There are labor market policies, and that's where I'm going to end up. So it's not that you can't do something about it. It's just maybe you shouldn't lean on the monetary policy maker to do a lot about it, because as we're going to see, what the monetary policy can do is kind of too blunt of an instrument to fix all these problems in this particular economy. That's the intuition. So I want to take this as an important baseline for contemporary U.S. monetary policy and even global monetary policy. So I'm going to discuss just a few key aspects of this analysis and then address some possible reactions that you might have to this work. Okay, now I'm going to show you a few equations. So if you want to get your coffee or check your iPad, this would be a good time to do that. I just want to put up two equations, and we're not going to go through in any detail, but I just want to get a flavor, if you're not used to this kind of thing, a flavor of the kinds of things that are always going to happen if you try to think about these things seriously. So here's the equations. These are 1 and 2 here, and the variables are pi. Pi is always inflation in this world. And U, which is unemployment. And pi isn't just the level of inflation, but everything's in terms of the deviations of inflation from your target. So first of all, you have to set a target, and the FOMC has done that. And then the question is, how far away are you on inflation from that target? And then look at the unemployment. It's not just the level of unemployment, but this unemployment gap, and you have this UE here in this equation. UE is the normal amount of unemployment that you would get anyway. This is an economy that has unemployment in it. So what's happening is matches are breaking up every day. And those guys cannot just instantaneously get a job. They got to go search around to find a job and see if they can get a new match. So you have unemployment all the time. In addition to that, you have additional inefficiencies coming in. How intensively are they going to search? And for the firms, how many workers are out there looking for jobs, how intensively are the firms going to advertise for jobs. You've got other margins that are going on here above and beyond the fact that you just have unemployment even in normal times. So, and then there are shocks in this economy. Those are the R terms and the B terms, and there's a bunch of parameters which are Greek letters. So all I want you to get out of these, just the quick glance of those two equations is just a couple of things. First of all, everything's forward-looking. Today's values of the variables depend on my expectations of tomorrow. And if there's some engineering types in here, you know, well, my expectations of tomorrow, that if I keep substituting in the equation, I'm going to get the whole infinite future. So what's happening today depends on the outlook for the entire future. So this is a critical factor in all of modern macroeconomics, and it's no exception here, and it doesn't change when you go to models of unemployment. Inflation is expressed as a deviation from a target level. Unemployment is expressed as a deviation from the level that would prevail in a model with less frictions. You got rid of the sticky price problem. So their remark is that neither the level of unemployment nor simply the level of the unemployment gap correctly measures the appropriate objective of monetary policy. So you have to be careful on that dimension. Now, what you want to do here is pursue a policy, not one that you would make up or one that I would make up. You want to ask the guys in the model, what do you want us to do? How can the monetary policymaker help, given that the guys in the model are facing the sticky price problem and the fact that their job matches dissolve on them and they got to go search for a new job. Well, a big part of the paper is that Ravenna and Walsh show that the policymakers want, the households want the policymaker to minimize a loss function, which depends on inflation variability, depends on consumption variability. Those are kind of normal things that you would get out of the sticky price literature, but also on a term involving labor market tightness. That's the vacancies per number of unemployed worker. So that's exactly what is new in this paper and exactly what you would expect. If I go in this direction, then labor market tightness is going to be a huge factor. The sort of the condition of the labor market is going to be a huge factor. That's exactly what you would expect. So they did get that. So far, so good. Looks like now the policymaker will trade off between all three of these. So what should the policymaker now do, given that the policymaker can only do one thing, and this is going to be critical, you can only do one thing, adjust the short-term nominal interest rate. Well, the main finding is that price stability advice survives and does pretty well in this framework. So the policymaker should still keep inflation as close to target as is practicable. And if you wanted to express it as a Taylor-type policy rule, for those of you that use Taylor-type policy rules, they have an inflation term, inflation gap term, and maybe an unemployment gap term. If you wanted to express it that way, you'd put most of the weight on the inflation gap term and not very much weight on the unemployment gap term. So if you try to deviate from this policy and you say, well, I'm going to put more weight on unemployment, they spend a lot of time showing that, at least in this model now, this is going to create poor outcomes for the households in the model. The households would revolt on you. You'd have a revolution. They wouldn't like that policy. So the idea that the Fed should put more weight on unemployment does not fare very well in this analysis. In fact, such an approach might be highly counterproductive. So, of course, research begets research. So why is this the case? So we're going to look at just a second at another paper by Ravenna and Walsh about trying to get at the intuition in this finding. This paper is in the Journal of Monetary Economics this past year. Why is price stability close to optimal even when the labor market distortions are present? And these are significant labor market distortions in this model. Well, it's not a simple matter, but the basic idea is the policymaker has only one thing that they're doing. They're moving the nominal interest rate around. This is a model that has lots of things wrong. The prices are sticky. They're not representing supply and demand the right way. And the guys have to search for their jobs. The employers have to decide how many vacancies to post based on their expectation of what the workers are doing. The workers have to decide how intensively to search. So there's a lot of distortions in this economy, but the monetary policymakers only got one thing that they can do. They can move the nominal interest rate up and down. Well, it turns out that trying to address the labor market inefficiencies solely through monetary policy does not work very well. So basically what happens is, okay, I'm going to try to fix this. I'm going to move the nominal interest rate up. That makes one labor market efficiency better, but makes another labor market inefficiency worse. And so you don't gain very much on the labor side by doing that policy. So what comes out of the analysis is saying, well, just focus on price stability and use some other policies to address these labor market inefficiencies. I think that's the basic intuition behind this. So what this points to is that don't lean so heavily on the monetary guys to try to fix this problem. You've got to come in with other policy tools, and that suggests more direct labor market policies that will get at the types of inefficiencies that are in this model. In this paper, Ravenna and Walsh, I mean, you guys probably don't care about this, but they actually equipped the policymaker with a zillion policy tools. And then you can fix everything. You can have one policy to fix this, one policy to fix that. The right kinds of taxes and subsidies in the right places fixes everything, and you get the fully optimal policy. But the monetary guy can't do that. The monetary guy just has the nominal interest rate. So that's, I think, the guts of the intuition. All right, reactions. So I hope your reaction isn't going to be throw tomatoes at me. So one thing is, what about this zero lower bound thing? This is an economy that doesn't have any problems with the zero lower bound. You're not near the zero lower bound. Obviously, today's economy, we are at the zero lower bound. But if you think about what their argument is, they're saying that even if you weren't at the zero lower bound, and you weren't constrained at all in your monetary policy, you'd still have trouble addressing these labor market inefficiencies. So that's I think, probably not an issue from the perspective of what's being said here. Now you could say, what, this is just one crazy model and there's a lot of papers out there. That's certainly true, but these guys are leaders in this literature. Certainly not the last word on these issues. There'll be more papers written going forward, and I look forward to reading them and seeing them. But it does have a lot of this particular paper has a lot of advantages. So you got this search theoretic ideas about unemployment. That's the leading theory of unemployment. You got that idea into the model, and it's not an easy matter. You've got clear comparisons to the standard policy advice that comes out of the standard New Keynesian literature, so that's very clean. You're talking about how happy are the households with the policy. You're not asking about someone else's policy or putting in ad hoc policies. You're asking the guys in the model what they would want you to do. And you're calibrating to U.S. data, but they do other, you can mess around with other parameter settings. I don't think the parameter settings are really critical for the kind of the core ideas here, but they are matching up with U.S. data as best they can. So for all these reasons, I think these results should be considered as an important benchmark for U.S. monetary policy. So let me conclude. I'll just, and we'll get to the Q&A here, so you can sharpen up your pencils and ask me about this or anything else, I guess. So again, just to review what I'm saying here, if you look at the standard New Keynesian literature flowing from Mike Woodford's exceptional work in this area, the advice that comes out of that is that you should pursue price stability, really price level targeting. And practically speaking, this means let's keep inflation pretty close to target all the time. And the FOMC has actually done that more or less since 1995. So this has been very influential globally in central banking circles. And you can argue with it, but I'm not arguing with it here, but you can argue with it. And then the question is, if you want to, a lot of people look at high unemployment today and say, well, why doesn't the central bank put more weight on unemployment in its decision-making process? But as I'm pointing out here, frontline research suggests that if you put more weight on unemployment, you might get counterproductive outcomes. Price stability remains the policy advice from this literature, even in the face of serious labor market inefficiencies. So I want that to be the benchmark thought for monetary policy in the U.S. And again, I think without getting into a lot of technicalities, and which might be beyond my pay grade, I think that the essential intuition is the monetary guys can only do one thing. They can adjust the nominal interest rate. That isn't enough to be able to address the multiple inefficiencies that would occur in an economy like this. For that, you got to bring in other policies. That seems like a sensible conclusion to me. It's not that you don't want to address unemployment. It's just it's not a good way to address unemployment inefficiency. So I'm going to stop there, and let's go to some Q&A. Thank you.
Audience could wait for the mics, please. We want to capture the audio.
Thank you. My name is Andrea Besoris, and I'm a locally based bank analyst. And thank you for coming to speak to us and participate. Two concerns I have are that, and I know I don't think monetary policy can alter these, but tell me what you think. But perhaps over the consumer price index, which I believe is a disingenuous and a flawed, deficient calculating tool for determining inflation, I think policymakers and monetary economists rely on that kind of data. So if you can address, because it excludes the inflation in food and fuel, which the vast majority of Americans experience or encounter. And then my next concern is in the multilateral agreements to which the U.S. is signatory, like the G20 agreements, there was to be no net new job growth. And I don't recall exactly when the U.S. went into G20 acknowledgement or as a signatory, such that our Congress or whoever our policymakers are that connect us as signatories to G20, but no net new job growth has been since at least the mid-90s, I think. And so the deindustrialization, the free, i.e. the nice word for trade importation, like i.e. importation, has been, to eliminate tariffs on that. So free trade is part of the deindustrialization. Then you have the negative ripple effect, so you don't have job creation under what we'd ordinarily enjoyed prior to G20 agreement, et cetera. So if you can discuss perhaps a better calculation to more accurately describe inflation and why, whereas many of us have felt the impact of like the derivatives driving up the price of fuel or the impact of these things, these instruments, the financial engineering that has really altered even the quality of financial intermediation. So you have all of these new instruments that have just done a lot of deleterious impact. And then deindustrialization has caused a flip side of that is that a greater exposure of our economy to real estate and the financial sector. So, there's a lot of policies that, as you say, aren't necessarily in the formulas that you're talking about.
Yep.
So.
No, there's much is not in the model. That's certainly true. I don't know a lot about the G20 agreements because I'm not directly involved with that, but I know a lot about inflation and measures of inflation. So let me just riff on that, and I agree with you completely on the core versus headline inflation issue, and so let me talk about that for a minute. If you look at, if you're the man on the street and you're experiencing price changes, the typical interaction is at the gas station and at the grocery store. So if you exclude food and energy prices, you're excluding the main interaction that a typical household has in a week with markets. So I think it really hurts Fed credibility to talk about so-called core inflation, which excludes food and energy prices, because it creates a disconnect between the households, Main Street America, and what the Fed is saying about inflation. They see those prices every day, so you have to address those prices. Now, headline inflation is more volatile than core inflation. Core is smoother, but I'm sorry, that's the policy problem that we have. Those prices are kind of volatile, and that's up to the Federal Reserve to try to keep them stable and keep the headline inflation number closer to target. Now, there is also the issue of CPI inflation, consumer price index inflation, versus personal consumption expenditures inflation. Those are two different calculations of the inflation index. The official line of the Federal Open Market Committee is that we target personal consumer expenditures inflation. We think the weights there are done a little bit better than they are for the consumer price index. The concern that maybe there are things that certain types of prices that aren't properly accounted for in the universe of prices in these indexes, I don't really agree with that. I think that these are the best measures of inflation that we have, and that they do include, for instance, housing is calculated in through the owner's equivalent rent calculation and so on. So, these measures of inflation that we have are pretty broad, and we try to get, you try to get the weights right. The weights are changing over time, but you try to get the weights as right as you can. Calculating a price index is actually a very difficult technical problem. If you've ever looked at it, it's very difficult. So, so let me just finish on that by saying one thing about inflation. Inflation's running very low by the PCE measure right now. Year-over-year PC inflation is about 1.3% measured on headline or core, but measured on headline, which would be my preference. That's pretty low. I'm getting concerned about that, and I think that that gives the FOMC some room to maneuver on it with its easy monetary policy, because I'd like to see that come back up closer to target, and we're not there right now. So I'm hoping that, I'm thinking that that will happen this year, but we'll see. Go ahead.
There were a lot of hands, so let's keep the questions pointed, please.
Just to get to the point, do you think there would have been a financial crisis had the federal government not been the catalyst to try to achieve social programs through financial institutions or other business institutions and coercing them in order to get their goals achieved? Secondarily, do you perceive that there are any policies currently that are going to create employment coming out of this government?
You know, did the government create the financial crisis? So, you know, you're talking to me. I'm an equilibrium macroeconomist. The government's part of the equilibrium, absolutely. So you set a bunch of policies, and then everyone optimizes in the economy given those policies. The policies are changing over time. This is the equilibrium in the economy. So you can't get away from and say, oh, the government's going to step out of everything. Whatever policies you have are dictating what the equilibrium looks like. And what we got was a very bad outcome in 2008, 2009. So, you know, is the government part of that? Absolutely. Absolutely. Are we going to create jobs? Well, job growth has been, one of the things that has happened is after the financial crisis, you got the Reinhardt-Rogoff effect. And what is that? Potential growth is lower after a financial crisis. Pretty substantial evidence from around the world over the last 800 years, according to Reinhardt and Rogoff. So, what happened in the US? Potential growth fell. So it's not, so we got about 2% growth in the last couple of years. That's a very persistent effect. And that's not very different from the history as we've seen it. So I think that they've got the right hypothesis for what happens after a financial crisis. You've done damage to the financial intermediation process in the U.S. economy, and it takes a while, quite a while, really, to unwind that damage and rebuild the trust that would have previously existed.
Thank you for your talk. Two questions. One is that, do you think under the current conditions, forward guidance is sufficient to get to either price stability or the goals of the Fed? And secondly, it's if Ravenna and Walsh are correct, then is forward guidance also sufficient to mitigate deflation risks? It's not clear to me that that's so.
So I like to think of current Fed policy as in two parts. There's the forward guidance question, which is to promise to keep rates low for longer, coming out of the new Keynesian literature. And there's also the quantitative easing approach, which is to buy government bonds and push down yields along the yield curve. I think that of those two, the QE is better, because it's a more direct intervention, and it's better understood, I think, by people in the marketplace. I think it has more direct effects on inflation and inflation expectations. You really especially saw that with QE2, which started in November, really in the fall of 2010, and continued through the middle of 2011. The forward guidance, I'm partly sympathetic to, but the forward guidance has a negative aspect to it. The negative aspect is that if the policymaker says that the short-term interest rate is at zero today and is going to remain at zero for some period into the future, private sector can take that two ways. They could take that as a sign that policy is very easy, and therefore there should be a boom today. but they could also take it as a sign that the central bank is pessimistic about the future outcomes in the economy, and that could reduce investment and employment today. So there's a double-edged sword, I think. So I've been very concerned about the pessimistic signal that can come from too much forward guidance. And I think the FOMC has improved on this dimension because we changed our forward guidance from a date-based forward guidance. We were previously saying that we would keep rates low through mid-2015. My interpretation is that markets took that as possibly a negative signal that we thought that the economy wasn't going to improve even in 2013, 2014, or 2015. And then that can have negative impact today. As we saw in these equations, everything's forward-looking in the economy. So that could have a negative effect. But we've improved that. So just last December, we switched to a threshold-based policy. So we didn't give a date. We don't give dates anymore. We say we're going to keep rates low because we're looking for stronger economic growth, and we're looking for inflation to stay close to target or not get too far above target. So we put in the thresholds instead. That's a state contingent way to say that we want to keep rates low until the economy recovers more strongly than it has so far. So I think that's an improvement, but I'm a little wary of forward guidance as compared to QE. That's why I've been an advocate of QE.
Thank you. My name's Tom Onsheen from DePaul University in Chicago. First of all, I want to praise you and thank the St. Louis Fed for the development of Fred. I can't tell you how important Fred has been.
I planted this question.
I honestly can't tell you how important it has been in my ability to teach economics and finance, and the continued improvements you've made to it, especially in the last 3 or 4 years, I can't. You know, it's just so important, and I'm very grateful for all the work your bank has done on that.
Let me stop you there. Thanks on Fred, and I know I get a lot of comments about our economic database, and hopefully we're providing a good public service here, and we welcome comments. We're trying to improve all the time. We've got mobile apps and other things that hopefully are keeping up with technology, so thank you very much.
You're welcome. I have 2 questions or comments. First of all, in your speech, you mentioned over and over again that the Fed has one tool controlling short-term interest rates. My observation recently is it seems to be more than one tool. You have short-term interest rates, and you have long-term interest rates now that you are have dramatically altered the maturity structure of the asset side of the Fed's balance sheet and holding more long-term Treasury bonds and long-term mortgage-backed securities. So really, you have 2 interest rates using open market operations, one tool, one instrument to regulate both the short-term end and the long-term end of the market. I'd like you to comment on the challenges of that and maybe the implications of that. And secondly, there's an enormous amount of excess reserves in the system right now. The Fed's balance sheet's been extended by we now have about over $1.5 trillion of excess reserves, which a lot of people are wondering, what will happen when the banks decide that it's more profitable to start lending those excess reserves out and then just keeping them at the Fed and earning 25 basis points. So can you talk a little bit about how the Fed is thinking about what might happen, and which we would like the banks to lend the money to stimulate the economy, but maybe the punch bowl will be taken away at that point.
Yeah, on the reserves, I think one thing to keep in mind is that the Fed does now have the power to pay interest on reserves, which we did not have before 2008. So if you look at U.S. Monetary policy over the post-war era, that was all an era where the U.S. could not, the Fed could not pay interest on reserves. But we can now pay interest on reserves. So the basic plan is that if the economy picks up and money supply starts increasing at a substantial pace, then we'll be able to raise the interest rate on excess reserves and keep some of that liquidity at bay. I think there are some controversial aspects of that because a lot of the payments will actually go to the very largest banks in the U.S. So If you think that's not a good outcome, tell me now, because the plan is to do exactly that if we get faster growth and inflation starts picking up. So you do have this interest on reserves tool, which I think is important. Now, the first part of the question was, in the model that I put up, the Fed only had one tool, move the short-term nominal interest rate in reaction to economic events. But it seems like we've got more than one tool now because we're also acting on the longer-term part of the maturity structure of the U.S. Treasury securities and also purchasing MBS securities. So I think, I'm a research guy. So from a research perspective, what you could do is you could say, well, suppose I come in and give the policymaker another tool. And then if I give them this other tool, would that allow policymaker to mitigate some of the labor market inefficiency that's in this model? And I'm skeptical that you could get that to work in the model, but that's certainly an open question for future research. There are other types of tools that are sometimes talked about for the Federal Reserve. If you read a money and banking textbook, they'll talk about reserve requirements or other types of things. So you could think about other types of policy tools. But the caricature of modern central banks is that they do one thing. They control the short-term nominal interest rate, and that's the spirit of the model and the spirit of the analysis here. So I think it would take, if you want to think of a policymaker that has multiple tools, you'd have to go back to the drawing board and put that in and see how that would help. The essence, though, is that there are these labor market inefficiencies that are just not well addressed by the types of things that central banks do. You want to get more direct to the guys that are unemployed. How are their incentives working? The firms that are hiring workers, how are their incentives working? And you want to get right to the point and not be over here in the financial sector somewhere. That's kind of a very indirect method of addressing these problems.
As I understand the search theoretic aspect of Ravenna and Walsh, and I'll get back to what you were actually talking about today instead of positing a question. And I don't know what the answer to this question is, but one part about it is the sort of severability of the employer-employee relationship in a downturn. And clearly, that is the Anglo-American model. You fire people.
Yeah.
In other cultures, Japan, Germany, other places, you have reduced hours, you have reduced wages, even in the case of Japan. And so the question is, does that hold up through all economies, right, and all cultures? And the second part about that is looking at the dramatic uptick in temporary and part-time employment, especially part-time for economic reasons in the current climate. Does that somehow change? I mean, obviously all research is backward-looking. You're looking at old data. We've seen this enormous uptick in part-time for economic reasons. We've seen this enormous uptick in the model of employment today. Does that somehow break down the Ravenna and Walsh conclusion?
Yeah, I don't think that the Ravenna and Walsh or this literature generally is going to be able to address sort of very directly issues about sort of changes in the nature of the labor market, where you've got a lot more part-time workers, a lot more temp workers. Yeah, it's people are working on that, but probably not in the context of monetary policy. So it would take some doing to get that kind of thing to come into the model. And it is a changing nature of the workplace. That's part of what's going on. What you might worry about is that policy is driving that changing nature of the workplace, that employers feel like this is a better way to get the hours that they need out of their labor force, and so therefore they don't want to get into long-term matches with workers. And what implications does that have for the nation going forward? I'm sorry, what was the first part of your question?
I was just pointing out that in different cultures there is elasticity.
Yeah. Oh, yeah. No, that's a really great point. So I want to elaborate on this a little bit. So the point was that the U.S. employment model maybe isn't quite the same. It's considered more freewheeling than, say, a European employment model. And I would say, in the context of what I'm saying today, look at Germany. is Germany's been very impressive on the labor market dimension through this crisis and through the current European recession. Very impressive. And what did Germany do? They undertook structural labor market reform about a decade ago. It took a long time to put in place, but it's a lot of specific ideas. You know, again, they're not leaning on the monetary policymaker. That's the European Central Bank. That's different. They're thinking about, if you're concerned about outcomes in labor markets, get to work and think about how you can solve problems in labor markets. And what they got was, with those structural labor market reforms, unemployment, you know, came down to a low level, came down below U.S. levels. Europe goes into recession. They're still at pretty low levels. Financial crisis comes along. They didn't really have an increase in unemployment. So if you look at some of the things that they did, I think those could be copied. If you're concerned, you know, about these issues, you know, you could copy their policy. So I think that that's a very reasonable thought on how the U.S. could approach labor market issues, rather than leaning so heavily on monetary policy guys who are going to have only blunt instruments to address these questions.
We haven't heard from?
Oh, am I calling? Sorry.
My name is Stefan Voss. I'm an investment banker. I can't imagine that the policy of a Federal Reserve Bank has some influence of, or could have a strong influence on labor markets, because I think, especially in America, the labor market has a structural problem, because they transferred a lot of their labor forces to China because of lower labor unit cost. You also mentioned Germany, because Germany liberalized its labor market, but I think your labor market is more liberal than the German labor market, so I don't think that this is a solution too. So my question is about when you say that the Federal Reserve cannot have a bigger influence on labor markets, and you have also a theoretical background for this, would that mean in the long run that the Federal Reserve will change or shift its paradigm? Because the Fed still has the obligation to stimulate the labor market also. For example, the ECB does not have this target.
Yes.
They only have a target on inflation, but not on unemployment. Could that mean that the Federal Reserve will change its paradigm?
Okay. Another great set of questions, and I really appreciate the sharp questions I get from this audience. Let me just say one thing about comparing Germany to the U.S. Let's look at youth unemployment. Youth unemployment, so let's divide the labor force into two groups, 15 to 25 years old and 25 and older, both in Germany and the U.S. If you take the U.S. unemployment rate for 25 and older versus the German unemployment rate for 25 and older, Germany's lower, but they're only lower by maybe a point or a point and a half, something like that. And these are lower numbers than what you're used to. And then if you look at the 15 to 25 group, youth unemployment, in Germany it's about 8%, U.S. is about 17. It's about 17. So when you're looking at the overall unemployment rate, a lot of it's skewed toward the very young guys. So a lot of unemployment policy has to be, you have to be thinking about, how am I getting new entrants into the labor market? How am I getting them integrated into jobs where they're happy and they're going to stick in the job? So I guess we're not doing a very good job compared to the Germans. And I think what they've done is think very carefully about you know, training programs. They put things right in the high schools and things like that, where they can move people right into jobs. They've also done other things about, instead of firing workers, reduce hours and things like that. So I think that's where, if you want to focus, this is not the focus of monetary policy. This is the focus of the Labor Department, it seems to me, and the Congress to think about, what can we do in these areas to get better outcomes. But a lot of it is focused on youth unemployment, and Germany has done a better job there. Now, I'm sorry, I'm losing track. Oh yeah, okay, so I'm interpreting your question to be that there's a dual mandate in the U.S. for the Federal Reserve, and that the ECB only has a single mandate. So the two central banks are different on this dimension. The ECB has a price stability mandate alone, and the U.S. has a maintain stable prices and maximum employment. If you read the Federal Reserve Act, there's actually a triple mandate. Moderate interest rates is the third part. So we're killing that one. And I always like to take credit. I always like to take credit for that one. So we're killing one of them. Maximum employment not looking so great right now, and price stability. But the point of this literature is not to say that you don't care about labor markets. You do care about labor markets. But the way to get the best outcome is, from the monetary policy perspective, on the dual mandate, is to provide the price stability. Then you get the best outcomes for the whole economy that you can get. That was the Greenspan take on the dual mandate, and I think it's still the right one. And it's the one that continues to come from the literature. You need other kinds of policies if you're going to address these inefficiencies in labor markets. All right. Thank you.